Welcome to today's webcast. KPMG has been approved by NASBA to deliver CPE-worthy training. In order to receive CPE credit, you must attend for the entire session and participate in interactivity checks. Interactivity checks will appear on top of your media player and may or may not be verbally addressed by presenters. Participation is tracked, and failure to participate will result in denial of CPE credits. If you have any technical issues during the webcast, please submit a question through the Questions and Answers panel, and our producers will respond to you directly. Please submit all content-related questions through the Questions and Answers panel.
Hello, everyone, and welcome to the KPMG Global Financial Reporting and Valuation Conference Real Estate and Hospitality session. We have a really exciting agenda for you all today, which is going to include an overview of our capital market outlook and valuation trends, followed by a panel of our current market strategies and opportunities in the real estate and hospitality industry. My name is Stephanie Petruzzi, and I'm a partner in our deal advisory practice, and I specialize in the hospitality and real estate industry, and I'll be moderating our session today. I'm also accompanied by Randy Rosen, a valuation partner in our real estate and hospitality practice, and Ian Pemberton, a managing director within KPMG's corporate finance practice that is also the group head of the real estate vertical. We'll also have a chance later today in our session to have a panel with Braden Mark and Bill Andrews, and I'll introduce to them later in our session today. And with that, I'll turn it over to kick us off with Randy and Ian on our capital markets outlook and valuation trends update.
Excellent. Thank you, Stephanie. We wanted to spend a few minutes this afternoon briefing you on what we're currently seeing in the market, what we've experienced over the last few years, and provide some guidance on trends we're seeing in specific industries and subsectors within the real estate categories. And the obvious place to start is with the story around the Fed funds rate. I think we all understand and have experienced and acknowledge that we have been operating in an ultra-low rate environment, really coming out of the great financial crisis. As a result, we've experienced a relatively low cap rate environment, and that has been something that has started to show some cracks recently. But if we look back over the last few years, we can observe is that starting in 2015 and through 2018, the Fed had started to nudge rates higher as the perception grew that the economy had started to recover. However, starting in 2019, we saw the Fed make 3 cuts as recessionary concerns started to set in for many reasons, including the expectation that we might have been entering a trade war, if you will, with China. However, as the pandemic set in 2020, the Fed took drastic action and pushed rates to near zero in an effort to prevent a deeper recession than what we all experienced, which was acute, however, not as severe as expectations may have been. As the dust has settled from the pandemic, what we started to see is relatively significant action from the Fed in pushing rates higher, including recent action yesterday with another 50 basis point increase. The broad consensus at this point is that that rate will ultimately settle in well north of 5%. And we are just starting to see the early impacts of how that will impact the transaction environment. Despite the upward pressure on rates, some of these fundamentals and leading indicators that many of us observe and follow relative to the impact of the rate increase as well as impact on real assets have remained relatively steady. Despite this rate environment, inflation has not abated to the 2% to 3% target that we know the Fed to be tracking towards. We are starting to see some deceleration in certain categories, including energy, commodities, and medical. However, it's far too early to tell if this is a trend or just noise in the data on a month-to-month basis. Employment remains strong despite waves of layoffs in certain sectors, including tech recently. Overall, we still have low participation, which is hovering around 62% versus 63% plus in the pre-pandemic environment. These two factors we will continue to monitor closely, as we are certain the Fed will, as they continue to take action on interest rates. In terms of cap rates, this has been something that's been interesting to follow, both in terms of the data and in terms of the anecdotes that we're hearing from the market. They, in the aggregate, initially declined in the face of rate hikes. But my perspective and in conversations with the market is that this is a function of a few things, and we are starting to see a slight uptick in the recent data. However, we will see in the following slide that transaction volume significantly decreased in Q3, and our expectation is that it will show a further decrease in Q4. And this informs my perspective on this slide, in that the amount of data that is populating the Q3 trend, I believe, is lower than the previous quarters. As such, I don't think we've really started to see, in terms of the comps that have been published, the impact of the rising rate environment. This has created some challenge for investors, advisors, and sellers alike around price discovery, given the lack of comps in the market. And these are the charts I referenced in my previous comments. And as you can see, we have started to see a slowdown in Q3. However, if you look back over the prior few quarters, you'll notice that particularly in Q4 of 2021, we've all just experienced quite a robust market in terms of overall activity. This is largely a function of the markets closing in the early stages of COVID and quickly rebounding as investors, advisors, and sellers alike acknowledged that there were certain categories that were likely to be in favor coming out of the pandemic, and we saw transaction volume accelerate, particularly within multifamily and industrial, two segments that proved to be quite resilient and generated quite a significant transaction volume over the last few quarters. Our expectation is that in Q4, we will see continued softening, and that is consistent with the commentary and discussions we are having in the market currently. Many transactions have been held out of the market given some of the dislocation, particularly in the credit markets currently, as well as challenges, as I mentioned earlier, around price discovery. However, we do believe that there is a light at the end of the tunnel in terms of transaction volume returning to somewhat of a normal level, which had, as you can see in the slide, the top chart on this slide, historically had been around 80 billion a quarter. And our expectation is that at some point in 2023, we'll see the market recover to those levels as we get more stable footing in terms of the rate environment. And that's partially driven by the amount of dry powder that's in the market currently. This is despite some headwinds in terms of capital raising volume among U.S. real estate funds through the first 3 quarters of 2022, and we're expecting that trend to continue through the Q4 data once it's available. But at the end of the day, our belief is that there are investors in the market, buyers in the market of real estate assets that are committed to transacting. However, this dislocation in terms of price discovery caused by the rapid increasing rate environment is just creating some challenges in terms of understanding how transactions will clear. However, as again, we get more stable footing in terms of transparency and clarity on where we stand in this market, our expectation is that we will see a recovery of transaction volume at some point, likely early in 2023. And with that, I will turn it over to Randy to pick up a discussion around the various asset classes.
Thank you, Ian. Let's start out taking a peek at the multifamily market, which has been very resilient and performed quite strongly this past year. Rent growth is expected to continue through 2023, but at a much slower pace. Rents rose by only $10 this past July, marking the 5th consecutive month of deceleration. Vacancy is expected to remain stable despite a significant amount of supply coming online, given that higher interest rates are making homeownership less attainable. Multifamily sale prices have increased 23% year over year. Inflation is impacting property expenses, particularly around payroll and insurance. Financing is available at 50% loan to value. In terms of the outlook, there is upward pressure on the cost of debt combined with the lower future rent growth, which has put an upward pressure on cap rates. Overall cap rates are expected to increase approximately 20 basis points in the near term, and inflation is expected to continue to impact property expenses. As we look at apartment total returns, we see that there's been a significant cool down from the high in 2021. What's interesting to note is that the projection of 9% return in 2023 is consistent with the 20-year average of 8.9%. Moving on to the industrial market. The industrial market remains one of the top performing property types. Given the limited supply, combined with the increased demand, continues to put upward pressure on asking rents. New deliveries are expected to be high through 2023. However, much of this space is already pre-leased, and the impact on vacancy is expected to be nominal. From an investment standpoint, sales volume is up for the first half of 2022, but down from the record high in 2021. Industrial sale prices are up 14% year over year. In terms of the outlook, the overall cap rates are expected to increase approximately 20 basis points in the near term due to tightening monetary policy. There are a variety of factors driving the industrial total annual returns down from the high in 2021. Industrial pricing is beginning to decline on the back of higher interest rates. There are more retailers are fulfilling online orders through their stores, Target Advance being an example, and there's an increased reliance on already built just-in-time delivery. Moving on to the office market. The office market has been the subject of the most interesting conversation since the onset of the pandemic. Net effective rents are down 2.4% year over year, and they're expected to continue to soften due to the weak demand and the significant concession packages that are needed to attract tenants. Sublease space continues to increase as firms are deciding what to do with their real estate footprint. Vacancy is currently at an overall rate of 17.6%. From an investment standpoint, the volume is primarily driven by demand for well-leased trophy assets, and there's really a bifurcation in the market right now between super class A, or what is referred to as AA, compared to the commodity class E, B, and C. There is a strong demand for the class AA. Financing is 25% loan to value if you can find it, with extremely high debt coverage ratios. It is estimated that up to 30% of the office space is currently functionally obsolete. Overall cap rates have increased by 60 basis points year over year and are expected to continue to rise. The future of office product is highly uncertain due to varying back to office policies, the number of firms that are downsizing, and the emergence of a new Super A, Class A, or AA asset class in transit-oriented developments. Office returns are projected to continue to decline as new user trends emerge. Moving on to retail. Retail sales figures have been strong in 2022, and a number of retailers are looking to expand. Performance varies by property type, Strip and neighborhood centers have outperformed the overall retail market, whereas regional malls have underperformed the overall market. Grocery anchored and experienced retail are performing very well, as are single tenant net leased assets. From an investment standpoint, retail is the only property type to benefit from decreasing year-over-year overall cap rates. In terms of the outlook, increased interest rates are likely to slow transaction activity and put upward pressure on cap rates. The magnitude of the pricing impact will vary based on the tenant mix, lease expirations, and the ability to raise rents. As we look at the retail total annual returns, they are projected to rebound from both pandemic as well as e-commerce pressures. Moving on to the hospitality market. Hotel performance has benefited from pent-up leisure demand. Hotel fundamentals have improved year over year and are currently strong. Demand has increased by 10.7%. Room occupancy is up 9.9%. ADR has increased 25.5%, which is 3% above the all-time high, and RevPAR has increased 38%. Overall cap rates have increased overall 90 basis points year over year, and higher interest rates are continuing to make equity and debt more expensive. In terms of the outlook, hotel operators and owners are bracing for the potential impact of increased rates on consumer spending. Typically, luxury hotels can raise ADR to pass through rising inflation and labor costs to a less price-sensitive clientele. The U.S. hotel ADR has made a full recovery. One factor contributing to the rapid ADR lift is insufficient availability of labor. Total accommodation employment is still about 20% below pre-pandemic levels. Unable to service all the room and pressured by rising wages, many hoteliers have increased rates to offset the differential as demand outpaces capacity and increasing costs continue to impact the bottom line. Higher interest rates are pushing cap rates higher in aggregate. As we can see from the slide, industrial, multifamily, and office have had the most significant increases, whereas to date, lodging and retail have been more resilient. Ian, I'll pass it back to you for a recap.
Thank you. So in terms of where we sit today, we are seeing rising rate put pressure on cap rates. As I mentioned in my earlier comments, largely, I think, still to be seen as transactions from Q4 and early Q1 start to settle and clear the market. At the same time, many of our clients are experiencing the impact of inflation as they operate these assets, which is in many cases cutting against their ability to increase rents and could be putting pressure on NOI, particularly margin. At the same time, these factors have resulted in a decrease in volume currently in the market and pending going to market, as the uncertainty is causing sellers to hold back and causing advisors to pause in terms of launching new deals into the market. In addition, we have seen offers coming in below ask or below sellers' expectations, which has resulted in some sellers pulling deals from the market. In addition, as I mentioned in my previous comments, we are seeing appraised values that are based on anecdotal evidence through the third quarter of 2022 come in lower or face additional scrutiny and challenges in terms of coming to a number due to the lack of comps in the prior quarters, including what we expect to see in Q4. This is leading to an overall, what I'm expecting to be somewhat of a repricing in certain asset classes that many sellers and advisors are in the process of digesting. But overall, once we all gather that information, have a chance to process it, my expectation is that we'll see somewhat of a return to normal transaction volumes at some point in 2023. And with that, we'll turn it back over to Stephanie to lead us into the panel discussion.
Fantastic. Well, thank you, Randy. Thank you, Ian, for sharing your thoughts and insights. And with that, we're now going to shift over to our panel discussion today to discuss the real estate and hospitality current market strategies and opportunities. So with me today, I'm accompanied by our three panelists, Ian Pemberton, who you've been introduced to earlier in our session today. But I also would like to welcome Bill Andrews, a partner and co-head of acquisitions for Equity Resource Investments, a real estate private equity firm that targets opportunistic returns, and Braden Mark, a KPMG partner in our deal advisory practice that also serves as our travel, leisure, and hospitality lead. So welcome everyone to our panel. And maybe just to get started in the conversation, let's first just discuss historical trends for the past 2 years. Specifically, in the pandemic, there were winners and there were losers. Can maybe each of you talk about some of the key themes and the impacts on certain asset classes? Maybe Bill, we'll start with you to kind of share your perspective.
Oh, sure. So, I mean, and we'll get into these in more detail, I think, as we go, but I think the simplest way to look at it is, residential multifamily was like the big winner for a lot of reasons. I mean, I think at the start of the pandemic, there was fear that would be the big loser, but there was so much stimulus money that was sent out by the government, and a lot of that money went to pay rent. So, multifamily benefited from stimulus, it benefited from low rates, and values just kind of like flew up. Industrial also has done very well for, mostly because of the fundamentals, and also low rates. All the leverage is less on industrial. And then, and it was touched on, I think office has had the most challenges, retail had a lot of challenges through COVID, but has rebounded a bit. Hospitality had a lot of challenges through COVID, obviously, but it has rebounded a bit. And then, the other food groups, it's a bit of a mixed bag. Although, self-storage, which is like not really a primary asset class, but we do participate in, has done like pretty well through it. So, again, big winners, multi and industrial. Biggest loser, office, and then there's a bit of a mixed bag in between.
Fantastic. Braden, any additional reactions from your side?
Yeah, I mean, I agree with all of those things. I mean, multi and just any property, residential for rent benefited from a macro trend that I think is continuing around a lack of desire for home ownership, further into age demographics. And so, that it's a little bit of a COVID effect. And then there's, I think, just an ongoing sort of macro trend around that's helped multi. I agree with industrial, primarily light industrial, logistics and warehousing. And, it's come as no surprise that as everybody ordered, 80% more of their goods and products from Amazon, that the need for more logistics rose very, very fast. And there was a flight of investors to go and try and grab a bunch of those assets. So that did really well. And then I spend, a lot of my time in hospitality, and it struggled for the first, 6 to 9 months. But as Ian and Randy alluded to, and we've been talking about here, it's been great for the past 12 months. It's been really, really good. So I'll wait on office. We can talk about kind of some views there, but obviously that's the elephant in the room when it comes to real estate investing right now and how to think about it. But a tough environment.
Great. And Ian, any final thoughts from your side on this one?
I think from a volume standpoint, heading into 2020, as I mentioned in the slides, the market had generally cleared about $80 billion a quarter in transaction volume. In Q4 of 2021, that number was about $250 billion. So the market also just digested a significant volume of transactions in a very short period of time. The rising rate environment has largely taken that to a halt. But in a lot of ways, I think the market is likely to be resilient, and we have all operated in a similar rate environment in the past, and we've seen transactions clear.
Absolutely. Now maybe let's switch our focus to the residential market. And what is the panel's view of the residential market in FY23 and beyond? Specifically, is there an expectation that we're looking at another GFC disallocation in FY23? And if not, why? Bill, would you like to start on this one?
Sure. So I think as far as like a big dislocation, I think the answer is no, for like a lot of reasons. I think first of all, while there's been a fair amount of supply added over like the last several years, there's been a real supply issue for housing in this country that goes back really to the Great Recession. And then on top of that, you know, if you go back to like 2008-9, I think unemployment probably peaked at like 10%, and it stayed pretty elevated for like a lot of years after. So, you know, we don't have a real unemployment issue at the time. So, you know, you still have supply issues in a lot of markets, especially for more affordable apartments. You have pretty much like kind of full employment, which is causing other problems. But that's kind of like that helps with demand side of housing. So I think fundamentally things are in pretty good shape. And I will say on our deals, you know, on the multi side, there are other concerns right now, mostly around debt and floating rate debt and those things. But for the most part, you know, most of our multi deals are, I won't say like they're all outperforming underwriting, but they all continue to stay pretty strong from the revenue perspective, you know, despite sort of what's been going on lately. And I think that will continue.
Great. Ian, anything else to add?
I agree with Bill's sentiment that I do not believe that we're looking at a great financial crisis type situation here, particularly within residential and multifamily. Fundamentals remain strong, strong employment, continue to see strong occupancy trends as well among our clients. We are seeing a little bit of uptick in vacancy on a quarter-over-quarter basis within certain geographies, but very small at this point, but something worth tracking. Many of our clients have experienced significantly strong rent growth over the last few quarters. I expect that to continue, but at a slower pace. And you are starting to see some softening and even declines in rents in certain markets as well. Southeast, Southwest are two that I would note. In terms of the supply side, what we are hearing from our clients and seeing in the news as well is that development particularly continues to be challenged. So in terms of new product coming to market, I think that we'll see the pace of deliveries slow as there's currently projects that may have permits to begin construction, but may have challenges in terms of credit markets, debt capital being available, and still some challenges around supply of certain products. But overall, I expect multi particularly to be a category that remains in favor, particularly as some of the other asset classes face headwinds.
Makes sense. And maybe as a quick follow-up there, given the affordability conundrum within residential and the current shortfall of inventory within single family, does this point to more multifamily opportunity? Bill, do you have any perspective on that?
So it could. I mean, the issue with affordability and housing is that you know, without subsidy in building affordable housing, the cost of construction is just kind of a little out of control. It's really hard to make a market rate deal work in affordable for like new construction, which points to the you know, in place existing assets continue to have strong demand. So yeah. I think that's why so much money goes into multifamily, in general, is because it is viewed as just a different risk profile than other real estate. And I think part of it is that solving the supply demand imbalance, sure, at the top of the market, like you can you can oversupply markets, but at the middle to bottom of the market, it's really hard to get out of balance on a supply point of view, unless you're in a market that's sort of like slowly dying job wise. But if you're in the Southeast or Texas or mountain states, I don't see supply demand ever being a real issue. The issues on multi are more, I think, on the expense side and insurance, and on the leverage side, because there's so much cheap debt available to multifamily that where people get in trouble is they just over lever. So if the dislocation comes through the next year or two, I think it's going to be more cases where people bought at the wrong time, they paid too much, they either floated their debt or had short-term caps, and they're going to be facing a reckoning for their business plans more than sort of a general sort of like reckoning in the asset class. Last thing I'd say is, like, the one thing I would say as far as like rent growth, my expectation is that employment stays pretty full. The one thing is that I don't have a good sense for is that, through COVID, you saw like savings rates go way up, and you're already seeing savings rates come down. So the one uncertainty is it's hard to know how much of the rent increases people are really like dipping into savings to cover rent. So there could be a little bit of softness on the rent growth side of it.
Yeah, totally. And Ian, anything else from your side that you'd want to share on that one?
Yeah, Bill, that's a good point in terms of the savings rate. And we're starting to see some challenges in terms of collections among our multi-clients. So that's something to keep an eye on. So far, I'd say it's well contained and varies by market and by operator, but definitely in the aggregate, something we're starting to see tick up. In terms of opportunity, we are seeing certain buyers and investors pull back in the market in a meaningful way, some of the open-ended vehicles particularly. So from an investor standpoint, I think that's going to bring some opportunity to buy at a higher cost of capital relative to where those buyers have been in market. And so they crowded out quite a few buyers. So I do expect there to be some opportunity there. And as Bill was referencing, related to debt structures within some of these assets and portfolios, I do think there's opportunities for investors to step into deals and into assets with operators, owners that are less well capitalized. So with any type of dislocation, right, we expect there to be some opportunity. The key here, I think, is be patient, be nimble, and keep a close eye on the underlying data, as well as the specific indicators within the submarket where the asset is.
Hey, Ian and Bill, I think you could probably apply this question to all asset classes, but I don't spend as much time in residential, so I guess I'm curious to hear from you guys around, will there be distress in residential because of over levered positions like you were mentioning, Bill? And I'm of the view that it broadly across most asset classes that we probably won't see much, and if for no other reason than creditors they don't want to foreclose like the great financial crisis. They ended up with all kinds of assets on their balance sheet they didn't know how to deal with. They didn't want to deal with it. And so in the early part of the pandemic, we saw a lot of forbearance, and I would expect that same behavior, if there continues to be some headwinds in residential, and I guess broadly, that makes me question, how much sort of distressed or really opportunistic opportunity is out there.
Yeah, I would say so. If you go back to the Great Recession, there wasn't a ton of distressed opportunities, even though you had a debt crisis and an operating crisis. So I think that owners working with lenders to find ways to extend deals will be sort of the norm, to the extent that there are problems. The opportunities might be cases where you're not buying from a distressed seller. You might be going in and saying, okay, well, the lender can do this, the current owners can do this. There's a shortfall of capital, so you might be able, and not all people buy that way. Like we buy that way because we're more like opportunity fund, but you might be able to take positions in deals to help right size deals to kind of get them through. So yeah, I think in general there will be this trend towards extending deals to make them work. But you still might have cash shortfalls in those deals that have to be solved one way or the other. The other thing you might see is it's not necessarily distress, but if you have a large owner who is really trying to target certain like cash yields to their investors, they might have deals in their portfolios that aren't really distressed, but they're not necessarily like cash yielding the way that they want. So they might start to rebalance their portfolios, try to sell off some of their lower yielding deals, hold on to their higher yielding deals. And if you're more like a long-term, like total return focused investor who doesn't necessarily need cash yields, you might find some buying opportunities. But it's always going to be at the margins. The only thing I would say in the current environment for debt in multi versus kind of the Great Recession. Great Recession, like that was a lot of CMBS debt. It was a fixed rate. It was like longer term. The owners were like very disparate. It was all very like, it was in some ways it felt like it was easier to extend because the stakeholders were so dispersed. You might have situations here where some lenders might want to work with the owners, but they might have their own issues on the backside, that they can't really do it. So the stress like shows its head in all kinds of different ways. But yeah, as far as like a wholesale, 1980s style, I can buy assets for 10 cents on the dollar situation. We can all dream, but that like never seems to happen.
Yeah.
Absolutely.
Yeah, I agree with Bill. I think there's, particularly given the volume of capital that's in the market right now, to fill some of those gaps. I expect many of those owners and investors to be proactive in terms of filling those gaps as well. So in many cases, they'll see it coming. And so we're starting to hear that from prospective clients around gaps in their capital structure as they face a need to refinance debt that's maturing as well.
Yeah, and I'm seeing people trying to raise money to do pref equity, anticipating that. A lot of bridge lenders become pref equity investors somehow, like when this happens. I mean, the one thing about it is that like the money will fill the void, as it comes, as long as the deals are, I would say the deals that are structurally distressed. I mean, where you run into problems is like where deals are structurally distressed and operationally distressed, and you can play there too. But that's you have to have a pretty strong stomach, I think, to get involved in those kind of deals.
Yeah.
Perfect. Maybe we can now shift a little bit to the retail sector, and specifically brick and mortar retail has been somewhat resilient in pockets across the U.S., really despite the impact of online retail from COVID. Maybe we can talk a little bit about the panel's viewpoint on this asset class over the next 2 to 3 years. Braden, would you want to start this one?
Yeah, I'm happy to. I think retail is, you can't think of it just broadly retail and total. I think we have to think about retail in different sort of sub-asset classes, and what's going to continue to be, productive and people will want to invest in, and what's going to kind of slowly die. So, despite I think 30 to 40% increase in online shopping during the pandemic, that started to come back down. And, people are returning. They've been returning to shopping really for 18 months. And I think it was Randy that mentioned it earlier. I think that the trend that we saw will be the one that we continue to see, which is, big box grocery, The Lowe's and Home Depot anchored centers, particularly with specialty retail within those centers, will continue to be, winners. They'll produce, and they'll be places that people want to invest into. And I think shopping malls and other kind of sub asset classes that have struggled are going to continue to. And people talk about conversions and doing other interesting things with these asset classes. It's malls, it's movie theaters, and I'm a skeptic. I just don't know that you can really pencil out ROI on a lot of these things, and trying to convert to something different than what they were kind of purpose built for in the first place. It's very costly. And Bill talked about the cost of construction. I mean, I don't think that's going to come down very much, if at all, in the coming years. So, those strategies to kind of fix the problem with those pieces of retail, I just don't really see it as viable.
Yeah. Bill, any additional reactions from your side?
Yeah, I'd say a couple of quick things. We do invest across asset classes, and we have invested in retail in the past. What I will say is that we have not been investing in real estate, in retail recently. And part of it is I think our investors will be like, well, what are you guys doing? Because it still just is, to the outside world, it just feels, I think the layperson sentiment is much more negative on retail than probably retail actually is. Because actually in some places there's a case to be made for investing in it. The one benefit of retail is that it's really hard to get over levered because the debt markets just don't really want it, which means that you have to be pretty disciplined on how you price it. So I think there's opportunity there. It's been hard for us to invest in it lately. The other thing I'd add is that we have had a couple of retail, old mall investments where we were able to repurpose parts of it for multi. But the reality is you can make the numbers work as long as you are willing to accept the fact that your actual retail investment probably isn't worth anything. Then the extra dollars look pretty attractive, but it is a little bit making sort of like lemonade out of lemons. So you can get to a place that's fine, but if that's your strategy to buy kind of broken retail and try to repurpose it, it can work. But you have to basically buy the retail parcel as though you're just buying raw land to do it. I think you can pay extra for the retail revenue and then convert it. So those are just my general thoughts.
Perfect. And maybe just switching gears slightly, in regards to closed-ended REITs, how has the current rate environment impacted these vehicles? Braden, do you have any thoughts on this one?
Well, again, we alluded to this, or Ian and Randy alluded to this, but when you have a closed-end fund that has a lifespan, you need to get money to work, but you have essentially negative leverage because of where rates are in the credit markets versus cap rates. It's really hard to get a good deal done. So I think some of these funds are going to probably have to figure out how to extend timelines with LPs and figure out how to be a little bit more patient until this disjointed bid-ask spread starts to come back together. And so I don't know how else you make a lot of things work right now, given where the credit markets are and what sellers' expectations are.
Totally. Maybe let's just switch gears again and we'll move on to office. What's the panel's view of office as an asset class in FY23 and beyond, especially the relevant performance of Class A versus Class B and C in large MSAs? Braden, do you want to kind of continue with your perspectives on this one?
Yeah, so I mean, I just some anecdotal evidence around office, and part of it is informed by what KPMG is doing, which I'm a part of that discussion with our own office space, and then conversations that we're having with some of our really large corporate clients. So there will be, I think, a reduction overall in Class AA or Class A office space in large urban centers. So there'll be a movement to try and reduce the total square footage in places like New York, and as you're reducing square footage, maybe even move to something that's a little bit more upscale or newer. This is public. That's what KPMG is doing in New York. So as you think about those asset classes in urban centers, I think that's going to be the trend, and you're going to have a lot of Class B and a lot of Class C stuff that really, really struggles. The areas that I think are interesting are sort of what I call the mid-burbs. So not like way outlying office space, but somewhere that's between, call it New York City and the middle of Long Island. And so, as people want to still come together, and there's value in, collaboration and being in an office, but we don't necessarily need everybody in New York. I think there's an opportunity for office space in that sort of geographic middle ground of being, way out in the burbs and being in an urban center. And so that is probably, kind of lower Class A or Class B stuff that just based on its positioning probably does pretty good. And I think there's going to be desire for that type of product.
Completely makes sense. Phil, anything else from your side to add to that?
Not too much. I do agree with that. That there's a market for office that's a little bit more convenient. The example I give is, I've historically not really invested much in office, but I have a friend of mine who offices he's in Denver, and his office is in Cherry Creek, which to me is that's a perfect market in the sense of there's just enough office, there's just enough apartments, there's plenty of retail. If the young people in your office want to work from home, but they have a 2 p.m. meeting, they can go from their apartment, they can zip down. So I think those more mixed use nodes, I think actually could be pretty attractive. I don't know what happens to like CBD office. It's a real challenge. And I guess people are trying to repurpose into multi, but I think being primarily multifamily, just trying to value engineer an existing multi-deal into a higher class multi-deal, that's hard enough. That is itself is a very hairy process. So trying to turn office into apartments, I think, can work in certain areas, but it's challenging. Somebody asked me for advice on a deal, and I won't say where the city is, but it was basically an office to apartment conversion in a city that's sort of it's like a middle market city. It's a real city, but at some point it's just hard. It's hard to think about, are you going to get a return on investment for that? And also I think people lose track of the fact that, especially in smaller cities that have vacant office, you don't need to do very many downtown conversions to multi to suddenly be oversupplied on Class A apartments. There's only those are not very deep markets. So we'll see where it goes. The last thing I'll say just quick is that it's one of these things where it's so up in the air. I think the people who will figure it out are the people who own it. Back to the question about will there be dislocation in multi. In some ways, I think that, not to sound like grinchy about it, but it's almost the office market is almost so uncertain that you're actually not happy to be an owner currently, but it's so uncertain that people are not going to jump in and try to take your property away. So they don't do it either. So there's actually an opportunity, I think, if you control it, to work with your lenders to figure out a way to buy the time to figure it out. And the question is just, can you, is the burn rate that it takes you to get to a place where you figure it out sufficient, like small enough where you can weather it. But I don't know what the long-term prospects are. I mean, I know the card swipes are not great in most cities, and I don't know where that's going to go.
Yeah. I mean, I think that just to add one last thing, there's the pandemic and work from home or hybrid work kind of environment that certainly has accelerated this challenge. But we also have a very tight labor market, and that might ease a little bit, but I don't think a ton. And when you're in a tight labor market and there's competition for your people, that I think is pushing employers to being more lenient around work environments, which means shortening commutes or totally remote or hybrid. But I don't think in most cases it means get yourself back to the office. And so, that kind of tells the story of what you can think of from an occupancy and demand for the product.
Yeah, the only thing I would add to that, this is more of my personal viewpoint on things, is that, when you look at the labor market right now and it's like so tight, the one thing that doesn't really, and I'm no economist, but one thing that doesn't get reported on that much is that productivity is also pretty lousy. And I don't know why productivity is so lousy, but my guess is all this hybrid work, or people not knowing how they're supposed to run an office, or changing policies on how people work all the time is a productivity killer. So I will say this: I think the current work environment is kind of busted, and it will settle into something that's more workable. That goes back to my other comment: is that if you own a bunch of office, I think your biggest goal right now is I just want to hang on. Let me just hang on and see how it settles out, and then I'll try to figure out how to make money on it. And some people are going to make a lot of money on office. It's just you have to have stamina and staying power to kind of figure out the best way to do it.
Yeah. Maybe let's just shift gears a little bit to industrial now. And industrial specifically has experienced significant growth on the back of COVID. Does the panel believe that this will continue, and do supply chain issues create further opportunities in this space? Bill, do you want to start on this one?
Yeah, I mean, I think that now I will say the industrial that we typically focus on is more B class industrial, even below B. And industrial is not my bread and butter business. I think my thought is that generally, I think the fundamentals of industrial should continue to be strong. That said, if you have there has to be some headwinds. There has to be some headwinds to industrial at some point. Rates are going up. Companies are have to tighten their belts. People are cutting jobs. So it seems on some level there should be some softness that kind of comes through. I do think it's a lot more resilient. Other than multifamily, it's a lot more resilient than the other asset classes. And then what it benefits from that multifamily is going to suffer from, I think, is that even when rates are really low, it's kind of hard to get in a super over leveraged position on industrials, because it's the debt markets are not nearly as loose for industrial as they are for multi, and most of the stuff that we are buying is being financed with local banks. So I think it has it's pretty resilient and fundamentally should stay strong, but I don't think it's bulletproof to headwinds, and it seems they should suffer some headwinds. I just don't know where they're going to come from.
Yeah. Braden, any other reactions from your side?
I mean, not really. The only thing I would say is, which is really just kind of echoing a little bit of what Bill said, is it cannot continue at the pace that we've seen over the last few years. So, whether that's, a a significant slowdown or just a moderate slowdown because of just the general dynamics. I don't know. I'm pretty certain there's not oversupply. I think there's going to continue to be a need for more supply. But I don't, it's hard to handicap like to what extent it slows.
Yeah. Maybe shifting gears now to the hospitality market. So the U.S. hospitality market experienced a resurgence in the second half of FY22 as countries ultimately relaxed COVID protocols. However, given the looming recession, what's the panel's viewpoint on the hospitality market in FY23 and beyond? Braden, would you want to kick us off there?
Yeah, so I mean, I think overall hospitality is gonna do fine, and it's gonna be a really attractive place to continue to invest. This morning, Highgate announced a transaction with Viceroy Hotels, so people are going to continue to get deals done. I think so. Stepping back from the real estate, as an industry, the last 9 to 12 months have really benefited from two things. One is people being locked in their homes for, some period of time and just pent up demand to get out and travel and do something. So there's just this human desire. And then the other piece is money. The consumer has more money in their pocketbook for a variety of reasons. A lot of it is government, stimulus and payments to people. And some of it is people just saving. We saved like $2.2 trillion as Americans, more than the normal rate in the first 18 months of the pandemic. So that $2.2 trillion is starting to work its way through the system. And this is a broader sort of consumer kind of spending deal. But we've only really worked through about a third of it to date. So there's still 2/3. Let's just assume that American behavior for the past 2 centuries prevails and we don't really want to save, we want to spend. That a lot of that money will continue to flow through the system. And so I think that will continue to create tailwinds for the hospitality industry for another year, maybe 18 months or so. But at some point it has to pull back. Like, I just don't think that today's pricing and the level of demand can maintain. And to me, that amount of sort of personal consumer dry powder is really the trigger. So when do people get tired of just spending excess money? And when that happens, I think ADR starts to come back. I think RevPAR starts to come back, and the transactions will start to slow, and bid-ask spreads will also change. It's a seller's market right now for sure.
That it is. And so just being a little bit mindful of time, I just want to thank each of our panelists today for participating in our sessions. We've had a chance to provide perspectives on all of the different asset classes during our panel today. And also want to just take the moment to thank all of our attendees for joining us today for the KPMG Global Valuation and Reporting Conference Real Estate and Hospitality session. We really hope all of you found this session today informative, and we certainly look forward to speaking with you all again soon. So thank you everyone for your time, and happy holidays.
Thank you.
Thanks.